Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Welcome to Trading with Venus podcast, episode 19. I am your host, Raman Gill. Thank you for joining me today. It's been a little while since we've been on the show together. I've moved across the country. It took some time to get settled in and get everything sorted out. But now that everything is all in its place, I am back on the show here with you, and we will continue our journey and our chats every week. So the topic of our discussion today is something that I've heard from many traders. This is a question that comes up quite often. And the question is, what is better, short-term or long-term trading? Now, this is a question that has been debated over time. And first of all, before we answer the question, let's get into the definition of the term. So what do we mean by short-term trading? Different people have different answers for short-term trading. For me, for the purposes of our chat today, let's define short-term trading as either intraday trading, where you are holding the trade for just the day itself for less than 24 hours, or it could be maybe for 1 or 2 days. So nothing more than that. And we can define long, medium, or long-term trading as where you're holding your position for maybe a few days or few weeks or over the longer period of months. So working with those definitions, let's get back into the topic. So what's better? Is it better to trade the short term or the longer term? Simple answer for that is it depends. This is a question that is very personal to each trader. It's a decision that each of us needs to make. Let's take a look at things that we should consider before we decide for ourselves as to what kind of a trader we are. The first thing would be you need to look at how much time do you have to devote to trading. Are you somebody who is very busy? You have a very busy schedule and you don't have enough time to sit in front of the charts or look at the markets every day. So if that's the case, you may be more suited to a longer term period where you can sit back and take your time making those decisions, especially if you only have, let's say, an hour a day to spend looking at the markets or hour a week. So you may be looking at a longer time frame so that you're not rushing to make that decision of getting into a trade. However, if you have more time on your hands, you're able to look at charts and you're able to be in the markets or look at markets during the day, or you're able to spend some time in the mornings or evenings looking at the charts and you're really interested and you stay up to date on the markets, then you can engage in shorter term trading as well, which can be quite profitable. Second is, what are the market drivers behind longer term versus shorter term trading? If you want to trade longer time frames, you are looking at trades that will be influenced by more of the macro factors, and fundamentals will come into play in that type of trading. So you want to keep track of the monetary policy, interest rate decisions, GDP, yields, business cycle for the particular country that you're trading the currency for. So all those factors will become more important when you're looking at the longer time frames. However, if you're only trading the short term, all you are really concerned about are the technical levels, which is not to say that you don't want to pay attention to the news. I absolutely recommend that you be aware of what's going on in the market at all times if you are engaged in any of the trades. However, for the shorter time period, you can take trades just based off of the technical levels. If all you're looking for is 30, 40, 50 pips, most big levels will provide you that type of returns in your trade. The third thing that you want to pay attention to is what type of market conditions are we in currently. If we are in a nice trending type of market, longer time frame trading is very beneficial. You can take a trade, or you have enough time to evaluate markets. You can then look for a pullback and then basically take a trade in the direction of a trend, and you will be okay. And place your stop loss behind the last swing level. A simple strategy strategy like that would work. However, if we are not in a trending market, for example, if the market is in a 3 to 400 pip range, if you're trading a longer time frame and you're looking for 500-600 pips, you could be in that range for weeks at a time. During those periods, you are not really making much returns on your principal because your market is going up and down. It's treading water. It's not really getting anywhere to get you the returns. However, these market conditions can be very beneficial for a short-term trader where all you're looking at is trading a range-bound market. You sell at the top, you buy at the bottom, and it can be very simple and quite profitable trading that way. Under those market conditions, shorter time frame trading is beneficial. Another thing that you need to keep in mind is your account size. If you have a larger account size, it's really easy to trade over the longer period of time. You can let your trade run, you can have a large stop loss and large take profit. However, if you have a smaller account size, you may not be able to carry the trade over the longer period of time because you could be in the negative territory for quite some time. And if your account size is quite small, then that could provide problems in regards to your margin. One way to get around that is by trading a smaller size when you are in a longer term trade. So you don't take your full position, you just take partial position. That way you can manage the position better. You can adjust your stop loss, or you can add to the position if the position is working in your direction, or you can take away from it. Trade management or position management becomes easier when you're trading with smaller size, not your full position. However, if you're trading a shorter time frame, because your stops are so tight, you can take a larger position size. However, I still recommend staying below 5% of your account at any given time. And the last thing that you want to consider is your personality. Do you have the patience to sit in the trade over the long term? Or are you someone who gets very antsy? Another question you want to ask yourself is, are you able to withstand the market going against you? And are you comfortable sitting on a loss? Many people, when they see position being in large loss, it may not have hit your stop loss. However, you may be negative in your position. For a lot of people, that's not a comfortable position to be in. So if you're more experienced, you may know how the market moves and where the market will potentially turn, and you can manage your position. However, if you're newer, you don't understand what the market is going or what's driving the market, this could be a very uncomfortable position to be in. So if you're someone who's not able to withstand large losses in your portfolio, this may not be something that you want to go into. You may want to try out the shorter term trading. As for myself, I like to have both in my portfolio. I have some trades that I let run over the longer term. There are some nice trending markets that you can get in with smaller position size and build your position over time as the trade moves in your direction. However, I'm the person who likes to be actively engaged in the markets. I'm very passionate about trading. I like knowing about the markets. I like reading the charts and doing my technical analysis. So for someone like me who likes to be more hands-on, shorter time frame trading is very important as well. So what I personally do is I allocate a certain amount of my portfolio to the larger time frame trade, whereas I do still keep another part of my portfolio where I take shorter time frame trades, where most of my trades in that part of my portfolio I will close within the day. So again, going back to the question, it really depends. And an analogy that I can give you is when someone says, what's better, running marathons or doing sprints? And my experience is that they both require different skill set and they both have different considerations in terms of how much training that you put in, how much time it takes, and the amount of effort that you would have to put into each, but each has its own benefits as well. So going back to the topic of trading, whether you choose to do shorter term trading or longer term trading, they are both good. Shorter term trading provides you lots of screen time, lots of monitoring of the markets, and really helps you build your skill set quickly. Whereas the longer term time frame trading, you can take a more relaxed approach to it. It's not as stressful. You can just get in with the trend and stay with the trend for a longer period of time. And they're both beneficial in the end. So that's all I have for today. For the show notes for this episode, you can go to tradingwithvenus.com podcast page, episode 19. Thank you once again for joining me today. I am so very grateful to have you on the show. Have a great trading week, and I will see you next week.
If you want consistency in your trading, we invite you to join our daily market analysis calls, where we provide the levels to find the best entries and targets on an intraday basis. For a 1-week free trial, please visit www.tradingwithvenus.com. Thanks for joining us today. With much gratitude, your show host, Raman Gill.